We're going to explore the credit score in and of itself, what makes it up, and how you can improve it. So stay tuned. There are 5 different parts to a credit score. Now, if you are starting off, you probably don't even have a score, but once you get started, it usually takes around 6 months when you get into the system, your score can range within these numbers. 300 to 850 are the numbers. So you will fall somewhere within that range. You want a high score because if you have a high credit score, it's going to be easier for you to get a loan when you need it or a credit card, and you will get a lower interest rate. If you have a lower score, it might be more difficult to get a loan, and even if you are approved for the loan, your interest rate or what the financial institutions are charging you will probably be a lot more. So what are the 5 things that make up your credit score? The first one is payment history. 35% is payment history. It's the number one thing that matters when it comes to your credit score. You really need to make sure that you are paying back your loans on time and your minimum monthly payment on your credit cards. All of this information is gathered and reported by those 3 bureaus, Experian, TransUnion, and Equifax. If it's good information, hopefully your score will go up. If you are late paying those bills, your score will probably go down. So you want to make sure that you are on top of your payments each and every month to ensure that you are maintaining or creating a good credit score. 30% is amounts owed compared to what you can borrow. Now keep in mind, things on your credit report can stay on there for 7 to 10 years. So it's really important, first of all, that things are accurate and that you're monitoring it. But when we talk about this idea of amounts owed compared to what you can borrow, we're looking at capacity level. Keep in mind, credit is all about risk. Lenders are looking at what kind of risk you are. Some of these things might not make a lot of sense financially, but can help your credit. So you want to keep in mind that this is a tool for your finances. It's not the answer when it comes to your overall financial health, but it is a huge component of it. Here's what you want to do. If you, let's say, have a $1,000 limit on your credit card, you never want to max that out. That will hurt your credit score. However, lenders do want you to utilize your credit, so you could use around $300 to $400 a month on a $1,000 credit card, and it would be fine. All of those things will come together and hopefully boost that credit score. So you're paying your bills on time, you're keeping your capacity at a decent level, and then you want to build your credit history. The third thing is length of credit history. So lenders want to see a long credit history. So if you are just starting off, you're a young adult and you have no credit, that's okay. You can get started. Perhaps get a very minimal either secured loan or a credit card for around $250, buy gas on it, pay it off each month. It takes at least 6 months for you to even get a score once you get your first loan. Now keep in mind, if you do have a student loan in your name, a lot of young adults, the student loan might be the first type of credit that they've taken out. That is being tracked by the bureaus as well and reported. So you want to be on top and manage those as well. Okay, so you're creating this length of credit history. And I always get the question, all right, Jerry, can I cancel my credit cards? Will it hurt my credit score? The answer is, if you cancel your credit card, especially credit cards that you've had a really long relationship, yes, it probably will hurt your credit score because you're canceling out that length of credit history that you might have had with that specific company. So maybe you just keep your credit cards open and not utilize that credit. However, you want to keep your financial goals in mind throughout the process. So if you're really worried about debt or identity theft or something like that, and you're not getting ready to buy a house or buy a car or need a loan within the next 6 months, it might be okay to cancel out that credit card just for your own peace of mind. Again, it's about knowing the big picture and how to manage it. The fourth piece is 10% is new credit. Every time you apply for a loan, it's actually what we consider a hard hit on your credit score, and it can bring your score down by several points. So you really want to limit your credit card, your loan applications, all of those types of things to when you really need to access that credit. If you are getting ready to buy a car or a home, say those really big ticket items, it's always a good idea to shop around, right? You do have a window of time for specific ticket items. So example, if you are shopping for a car, you could go to multiple dealers, lenders to see where you are and what your interest rate, that counts as one hit within a certain window. I always say be safe, keep that shopping within that 30-day window. Now, if you shop for a car, that's a hard hit, and then you go and shop for a mortgage because it's a different type of loan, that would be considered another hit. So keep all of those things in mind as you're planning out how you're going to utilize your loans across your financial plan. Lastly, is 10% is types of credit used. So they're really looking at this overall picture of how you are using your credit and what type of credit that you have. Is it a revolving type of credit, like a credit card? Or perhaps it's a loan, like a car loan where you're making a specific payment each and every month, a mortgage, a student loan. What does your loan kind of portfolio look like? Lenders like to see the kind of a variety of that and how you're managing it. So if you can capture these 5 things and take control of it, it will really help you with your overall financial plan. So where should you even go to access your credit report and credit score? We recommend that our members go to www.annualcreditreport.com. You can access your credit report from all 3 bureaus, Experian, TransUnion, and Equifax, for free, and it will show you what is being reported and where you are. Now, you will have to pay for your score from that particular site. Let me say, it might be worth paying for your score if you're getting ready to purchase a big ticket item like a house or a car, just so you know where you land. You want to ask for your FICO credit score. There's different models out there, different entities. When we report out, there's tons of different websites that you can pull your credit from, but they don't necessarily give you your FICO score. And that's what really lenders tend to use when deciding on loan decisions. So that in particular is what you want to request. Now, depending on when you pull your credit, your score might vary because lenders report at different times throughout the month. So even if you pull your credit and then a few days later you go in to get a loan, there could be some differentiation there as well. So I hope today's topic was helpful for you. We're so excited and honored that you join us. We'll hope you join us in a couple of more weeks for Money Talk Mondays. We will be talking about and bringing in an expert about loans. What do I even expect if I were to come into Virginia Credit Union to get a loan? What is going to happen? What does the lender look at? So we hope you will join us then. Until then, manage your money well. Did you like what you saw today? Do you want to manage your money well? Please subscribe to our YouTube channel and feel free to leave a comment below. Hope to see you soon.